Good evening, investors. Welcome back with me, Madhaveshwari, on KleverStock, serving you the latest updates for the closing bell this evening. Kicking it off with the evening updates from Bursa Malaysia. Bursa Malaysia maintained its upward trajectory during mid-afternoon trading on Wednesday, supported by the persistent buying interest in heavyweight stocks within the financial services and utilities sector. By 3 p.m., the FBM KLCI had climbed 5.85 points to 1,707.53, building on the previous day's close of 1,701.68. Despite an initial opening at the index dipped slightly by 1.58 points, broader market sentiment remained positive throughout the session. Gainers led losers 492 and to 463, while 487 counters remained unchanged. Total market turnover stood at 1.71 billion units with recorded value of 1.40 billion ringgit. The banking sector was a primary driver for the index's performance, with Maybank rising 14 cent to 11 ringgit 80 cent, CIMB Group gaining 15 cent to 8 ringgit, and Public Bank advancing 3 cent to 4 ringgit 78 cent. Tenaga Nasional also contributed to the gains, ticking up to 2 cent to reach 14 ringgit 16 cent. Among the top gainers, Petronas Dagangan saw a significant jump of 40 cent to 21 ringgit 90 cent, followed by closely by Hong Leong Bank, a financial group, and Fraser and Neath Holdings, both of which gained 26 cent. Conversely, Nestle led the decliners, falling 2 ringgit to 102 ringgit, while Malaysian Pacific Industries slid 52 cent to 30 ringgit 2 cent. In the active list, AirAsia X and Capital A experienced slight declines, while Zetrix AI fell 1 cent to 77 to 5 cent. The broader market reflected the positive trend, with the FBM Top 100 Index advancing 52.62 points to 12,323.21 and the FBM 70 Index jumping 120.33 points to 17,185.03. Sector-wise, the Financial Service Index was the standout performer, surging 121.52 points to 20,798.58. The energy and plantation sectors also posted modest gains, reinforcing the market's overall resilience amid ongoing fluctuations in global energy prices. Now for some local news updates. Malaysia's labour market started 2026 on a firm footing, maintaining a stable unemployment rate of 2.9% in January. According to the latest figures released by the Department of Statistics Malaysia, the market continues to expand in tandem with favourable economic growth. Chief Statistician Dato' Sri Dr. Muhammad Uzair Mahirin noted that steady employment growth and a persistently low jobless rate remain the hallmarks of the current economic landscape. The national labour force saw a marginal increase of 0.1% month-on-month, reaching a total of 17.28 million persons compared to 17.27 million in December 2025. This growth was accompanied by a slight rise in the labour force participation rate, which edged up to 70.9%. Dr. Muhammad Uzair emphasized that these figures indicate a healthy level of engagement with the workforce. He stated in the official report that the labour force continued its positivity momentum during the month, indicating more labour participation in the market. While the number of employed persons rose to 16.77 million, the data also showed a slight uptick in the absolute number of unemployed individuals, which reached 509.6 thousand. However, this marginal increase did not shift the overall unemployment rate, which has remained at the 2.9% mark, a level many economists associate with full employment. The services, tourism and technology export sectors were cited as key pillars supporting the stability, providing a balanced recovery across the board. Looking ahead, the Statistics Department remains optimistic about the resilience of the labour market despite prevailing global uncertainties. Future growth in the expected to be driven by high-tech subsectors, fueled by advancements in automation, artificial intelligence, and a steady stream of foreign investments. Dr. Muhammad Uzair concluded that strong domestic economic fundamentals, also and stable labor, demand and supply will continue to support the nation's workforce as it transitions further into the digital economy. Still on economic news, China's foreign trade surged 18.3% to 7.73 trillion yuan, approximately $1.12 trillion in the first 2 months of 2026, providing a strong foundation for the country's annual growth targets. Exports rose by 19.2%, while imports grew by 17.1%, driven by a recovery in global demand and heavy investment in high-tech sectors like artificial intelligence. Experts note that this momentum highlights the resilience of China's economy and its role as a stabilizing force for the global trade. Economists from the State Information Center and Oxford economists point out that manufacturing and exports will remain the primary drivers of growth through 2027. The increase in trade is supported by China's industrial strength and gradual easing of the global trade tensions. As the domestic middle class expands, demand for international consumer goods is also expected to rise, creating new opportunities for global exporters. International businesses are also increasingly shifting their perspective of China from a simple marketplace to a sophisticated production and innovation hub. A recent report by the American Chamber of Commerce in South China revealed that 45% of surveyed firms now rank China as their top global investment priority. Despite global uncertainties, these multinational companies are integrating more deeply into the local economy to sharpen their global competitiveness. Reinvestment remains a major theme for 2026, with 75% of surveyed firms planning to put profits back into their Chinese operations. An estimated $13.79 billion has been earmarked for reinvestment over the next few years, specifically for localization operations and developing new technologies. This continued commitment from foreign investors underscores China's central importance in the global supply chain. Up next, we have some corporate updates. T7 Global Berhad subsidiary Tanjung Offshore Services Sdn Berhad has been awarded a contract by Enquest Petroleum Production Malaysia Limited for an integrated hydraulic workover unit. The agreement covers the 2026 and 2027 Enquest well campaign and is scheduled to run for 2 years starting from February 19, 2026. This partnership focuses on providing essential services across multiple wells located at various offshore platforms. The scope of the contract is comprehensive, requiring Tanjung Offshore to supply the HWU alongside a dedicated project management team. Additionally, the company will provide offshore supply vessels, pumping services, and specialized equipment for fishing and wellbore cleanup. These resources are critical for executing a workover and plug and abandonment (P&A) operations, which involve maintaining active wells or safely decommissioning those that have reached the end of their life cycle. T7 Global Executive Director Tan Kei Zin expressed confidence in the group's technical standing following the award. He noted that the company's ability to integrate the HWU with its exciting existing drilling jack-up rig T7 Inya allows it to offer a versatile range of offshore interventions. Tan said this award underscores our technical capability in delivering integrated well services, emphasizing the strength of the group's specialized wells and decommissioning division. Looking toward the future, the group anticipates a steady increase in demand for decommissioning services within the region. As older offshore assets require safe and efficient closure, T7 Global expects to see a robust pipeline of potential plug and abandonment projects. These latest contract not only bolsters the company's immediate order book but also solidifies its competitive position in the evolving Malaysian oil and gas services sector. Finally, wrapping it up with some commodities updates. Oil prices retreated on Wednesday as the International Energy Agency prepared to propose the largest release of strategic reserves in its history. Brent crude fell 1% to $86.92 a barrel, while US West Texas Intermediate dropped to $83.10. The proposed drawdown aims to counter massive supply disruptions caused by the escalations of US-Israel conflict with Iran, which briefly pushed oil prices as high as $119 earlier this week. The IEA's plan could potentially release more than 182 million barrels, surpassing the record set during the 2022 Ukraine crisis. Goldman Sachs analysts estimates this would cover about 12 days of the current 15.4 million barrel per day disruption in Gulf exports. However, some analysts remain skeptical, noting that the physical speed at which oil can be drawn from reserves may not be fast enough to meet the immediate market shortfall. Supply concerns remain high as the conflict reaches critical energy infrastructure. A drone strike recently forced the closure of Abu Dhabi's Ruwais refinery, and the US military reported destroying several Iranian mine-laying vessels in the Strait of Hormuz. While Saudi Arabia is attempting to bypass the strait by using Red Sea ports, current shipping data shows these efforts are not yet enough to stabilize the massive drop in regional oil flows. G7 leaders are scheduled to hold emergency talks today to discuss further measures to protect the global economy from the energy price spikes. Energy consultancy Wood Mackenzie warned that if the war continues to block Gulf supplies, crude prices could eventually climb toward $150 per barrel. For now, investors remain focused on the Middle East, gauging whether the IEA's intervention will be enough to provide long-term relief. Well, that's a wrap for Closing Bell Updates with me, Madhaveshwari. Thank you, investors. We shall catch up in the next session soon. Goodbye.